Welcome to Talk Tickers. So, Playtika just dropped its Q3 earnings, and honestly, on the surface, it's a bit of a head scratcher. You've got a revenue beat, but an earnings miss. Normally, you'd think the stock would take a hit, right? But nope, it jumped 5%. Today, we're going to dig in and find out what hidden story the investors were really focused on.
Yeah, this is the big question, isn't it? A beat on revenue is always good news, but then you see that miss on the official earnings per share, the EPS. So what gives with the 5% pop? Well, it's pretty clear the market is looking past the headlines and at something much, much deeper.
And here's how we're going to get to the bottom of it. First, we'll tackle those headline numbers that caused all the confusion. Then we'll dive into the real star of the show, their direct-to-consumer, or DTC business. We'll also unpack the surprising story behind Slotomania's decline, take a look at management's game plan, and finally, I'll give you our take on what to watch for next. All right, first up, the headline numbers. And just like the title says here, it's really a tale of two different earnings figures this quarter. Okay, so here's the breakdown. Revenue was a solid beat, no question there. But the earnings per share, the EPS, that's where it gets a little tricky. The official GAAP number, that missed what analysts were expecting. But, and this is a big but, the non-GAAP number, which is what Wall Street really pays attention to because it strips out one-time items, that actually beat. So the market looked at this and basically said, okay, we care more about the core business, and the core business looks strong. And that revenue beat, it wasn't just a squeaker. We're talking 8.7% growth compared to last year. In a market this competitive, that is a huge signal of momentum. But believe it or not, that's just the tip of the iceberg. The real story this quarter is all about how they're making that money. Which brings us right to their direct-to-consumer platform, or DTC. You can almost forget the noise around the EPS numbers for a second, because this is the metric that really explains why the market reacted so positively. Just look at that number. $209.3 million. That is a record for their DTC business, and it's up a whopping 20% from this time last year. What this tells you is that their big strategy, connecting directly with players and cutting out the app stores, is really, really starting to work. And this chart here, it really puts it all into perspective. DTC now makes up almost a third of their total revenue. And management's goal? Get that to 40%. So why is this so critical? It's pretty simple, actually. It means more profit on every single sale, it means they're less dependent on Apple and Google, and they have total control over the player experience. This isn't just some side project. It is fast becoming the core of their entire business. And a huge piece of this growth is coming from one place, that Superplay acquisition they made, specifically its hit game Disney Solitaire. The CEO himself said it's the fastest growing title in company history. This is their strategy playing out perfectly. Buy a great game, and then plug it into your powerful DTC platform to pour gasoline on the fire. Now, we have to talk about the elephant in the room, that massive decline in their legacy cash cow, Slotomania. But this isn't a story of a game just falling off a cliff. No, this is a story about active, hands-on portfolio management. I mean, look at that drop in Slotomania's revenue, down almost 47%. That's jarring. It looks scary. But this is not a sign that the whole company's in trouble. Just look next to it at their other huge game, Bingo Blitz. It actually grew and hit a new record. This contrast is everything. It shows this is a deliberate surgical move on one game, not a company-wide crisis. And management was totally upfront about this on the call. They said they are intentionally pulling back on Slotomania, they're fixing the game's economy, and they're cutting marketing spend that just wasn't giving them a good return. They're not promising a quick fix either. This is a long-term play to get the game back to a healthier, more sustainable place. So, you've got one growth engine firing on all cylinders, and you've got this legacy game getting a major tune-up. So what's the overall game plan? Let's take a look at what management is telling us about the future. So here's the playbook. First, and this is a big one, they're sticking to their original financial targets for the entire year, for both revenue and EBITDA, which is basically a good proxy for cash flow. That signals a lot of confidence. They're also not sitting still. They've got a brand new slot game coming soon and another Disney title in the works. And behind the scenes, they're leaning heavily on AI to get smarter. It's a really clear strategy. Defend the core business while investing in new areas for growth. And then they announced this, a brand new quarterly dividend. They're going to start paying shareholders 10 cents a share every single quarter. For a company in the mobile gaming space, this is a huge deal. It's a powerful signal from the top that they are extremely confident in their ability to generate a lot of cash for a long time to come. All right, so that's the whole story of Q3. Now it's time for our final segment, The Next Call, where we give you our take on what to expect when they report Q4 and beyond. So we're going to lay out our prediction in 3 simple parts. What we expect to see from the Q4 results themselves, how we think the stock is going to trade after that, and finally, we'll give you our official rating on the stock. So here's my take. For next quarter, I'm expecting the results to be right in line with what Wall Street is looking for. That incredible DTC growth will probably cancel out the continued planned weakness from Slotomania. For the stock itself, I think it's going to trade sideways for a while, just kind of range-bound. The market has given them credit for the DTC strategy, but now comes the hard part. They have to prove it's sustainable. And that's why I'm rating the stock market perform. The pivot is absolutely working. It's the right move. But the execution risk here is still really high. Can they truly stabilize Slotomania? Can the new games really take off? With a ton of debt on the balance sheet, there is just not much room for error. They really need to nail the execution.
So, that's the story of Playtika's quarter. It's a company deep in a major transition, but it looks like they're successfully pivoting to a much more profitable model. It's going to be fascinating to see how this all plays out. As always, this analysis is for informational purposes only. It is not financial advice.